Lance, can you or Chris, can you guys just see the one slide?
Yep.
Okay. Well, good morning, everybody, and thank you for joining our webinar today. I am Amanda McLean, the Farm Management Specialist here at North Dakota Farmers Union, and I will be moderating our webinar on Beyond the Field, a crop insurance update. As these webinars are intended to provide you with the latest information and have in-depth conversations with our experts. These webinars are held the third Thursday of each month at 10 a.m. Central Time. A few housekeeping tips before we get started. Everyone is on mute, but if you have any questions at any time, please type them into the chat box at the bottom of your screen. We will have time for Q&A at the end of this presentation. Also, this webinar is being recorded, and if you'd like to rewatch it, you can search it by going to YouTube and typing in North Dakota Farmers Union. We ask that you please take the exit survey at the end of this webinar as it helps us to continue to build content to improve these webinars. To have us talk about crop insurance updates for 2026, we have experts Lance Gullickson. Lance is a farmers union insurance agent in Lisbon, North Dakota, and he has been an agent since 2006. He lives in Lisbon with his wife and two kids. He is also an active partner in his family farm and ranch and enjoys working in all areas of agriculture. We also have Chris Arnstone, who is a farmers union insurance agent in Maddock, North Dakota. Chris has been an insurance agent since 2011. His area where he works in Maddock has a diverse area mix of crops, including soybeans, wheat, corn, dry beans, barley, flax, lentils, you name it, and livestock. Chris enjoys the variety that comes with working with his producers. With that, I will turn it over to you, Lance and Chris. Thank you.
Thank you. Good morning. First of all, we'll go through the agenda. We're going to go through the changes that are coming up for 2026, the impacts of the One Big Beautiful Bill. There's some new products and some options that may be suited for you. We're going to go through how they work, the basics on crop insurance, and we'll go through some rules and deadlines here at the end. First of all, on the One Big Beautiful Bill that was passed this past summer, some of the highlights of the changes on there. This really brought a lot of changes to the crop insurance world, and a lot of them were good. Majority of it was beneficial for the crop insurance. First one was beginning farmer and rancher. The beginning farmer and rancher saw some benefit changes, and we'll go through that here in a little bit. One of the things that changed was in the past, if you're going to take area risk coverage or ARC coverage through FSA, you could not purchase SCO through your crop insurance. That has changed. So if you want to take ARC, you can still purchase SCO. Some of the area-based plans like ECO and SCO has some premium improvements that are a result of because of subsidy changes. And then the underlying policies, your YP and RP policies, there's also premium support changes there also. One of the items that was detrimental was the additional PP buy-up was removed, that additional 5% buy-up. But then on the PP side, the one thing that improved was that there's rules flexibility that was increased. And for those that have whole farm revenue policies, there's also a subsidy change to that. First of all, in the beginning farmer and rancher, this beginning farmer rancher has been around for over 10 years. It became part of crop insurance with the 2014 Farm Bill. And in the past, you were considered a beginning farm rancher if you had less than 5 years of experience. And there was premium subsidies. The biggest advantage to it was that the additional premium subsidy that you received. There are some additional benefits beyond that. You don't pay the policy fees. There's some additional relaxing of transfer of APH and other items, but the biggest advantage is going to be the premium support. And what changed with One Big Beautiful Bill is that increased from 5 years to 10 years, and it also increased the subsidy rate that's paid in those first 4 years. So now somebody that's a beginning farmer rancher and then their first 2 years of eligibility, they're going to receive a 15% premium subsidy. That third year, it's going to drop down to 13%. The fourth year, it's at 11, and then those remaining 6 years, you're going to get a 10% subsidy. One thing to keep in mind is there are some people that may have aged out of this. They may have had their 5 years of eligibility up and entering 2026. Now they may be on their seventh year, so they may have dropped out of it, weren't eligible for any type of subsidy in 2025 because that was their 6 year. What's going to happen is if you're with your existing AIP, they should be rerunning those and putting you back into beginning farmer rancher status. If you've transferred AIPs, you will have to complete new applications. Or if you're, new coming to farming or purchasing crop insurance, you're also going to have to complete an application. And one thing to keep in mind for a spousal or any type of entity that includes more than one person, all the SVIs or all the individuals need to complete that application, and that has to be done by March 15th. So that deadline's coming up. So that 15% premium subsidy, it's not just a 15% reduction in premium because you got to keep in mind a lot of these policies are subsidized anywhere from 65 to 80% already. So what it really equates to is quite a large decrease in the farmer paid premium. If somebody's at the 75% enterprise unit coverage, it'll decrease their out-of-pocket premium by 75%. If they're at the 70% optional unit coverage, it's going to decrease that out-of-pocket premium by over 40%. And for those area-based plans, the ECO and SCO, it'll decrease that out-of-pocket premium by 3/4 also. And here's just an example. It's just a theoretical Benson County beginning farmer rancher with a 35 bushel APH soybean crop. On a 70% optional unit policy, he's going to be paying $8.30 an acre for that underlying revenue policy, whereas an experienced farmer rancher is going to be paying about $6 more per acre, over $14.23. And then if you look at the ECO and SCO, those premiums are cut by 75%. So you add it all up, somebody that's in that situation, they're going to be paying less than $10 an acre, whereas their counterpart would be an experienced farmer rancher would be paying over 20, 21. And you go to the enterprise units, you can see also how low that premium can get with all those additional subsidies applied. 75% revenue protection enterprise units, premium is going to go from 680 something for experienced farmer rancher down to $171. You add that all up between the two, he's going to be paying a little over $3 an acre, $3.20 some cents versus his counterpart. It's going to be paying around that $12 an acre range. So it's a really substantial savings, and it's something to take advantage of if you have an individual that's coming into your operation, somebody that might be phasing in. This is something that it's put in place to help those young producers. And I'd encourage you to take advantage of it. Not only did we see changes at the beginning farm rancher, we saw premium support increase for the underlying policies, the revenue protection, yield protection. So those that had a basic unit or optional unit, those premium subsidies increased by 5% for where we see most people insured at. So in the past, if you're at 70% optional units, you're being subsidized. 59% of the premium was being subsidized. Now it's going up to 64%. Enterprise units, majority of our producers we see at that 75% level. Those subsidies are going from 77% to 80%. Well, what does that really mean? So if you take and you look year over year, 25 to 26, if everything was equal, you're looking at the same APH and same spring price on the crops. If you insured everything the same, you should be seeing about a 12% reduction in your premium. If you're on optional units, at 70% optional unit level, if somebody's at the 75% enterprise unit, it should see about a 13% reduction in that premium. And then on the ECO and SCO level, we're looking at reducing that premium by over 40%. So that gives us some flexibility. And here's just kind of a chart of what's happened in the last 3 years. You can see that the underlying policies we've seen, like their RP policies, we've seen an increase in the subsidy rate. It's up to 71% on area-based plans, the SCO. that was at 65 for both 24 and 25. Now it's gone to 80. But then you look at the ECO, that was at 44% only in 2024. Last year it jumped up to 65, which made it a little more affordable. Now it's went to 80. So in the past on that ECO, when it first came out, you're looking at when you're looking at purchasing it, it's top level coverage and it's the coverage that pays the first, but it's quite expensive. You're paying about $1 premium for every $3.50 of coverage that you're receiving. And now that's changed where on the ECO, in general, you should be getting about $10 of coverage for every dollar of premium. And on the SEO, you should be getting about $20 of coverage for every dollar of premium. So what these changes, it's going to equate to a couple different things. It's going to give you some premium savings and it's going to give you some options. Again, this is just theoretical, where we got Benson County wheat, 60 bushel APH for a producer. On the top chart there were optional units, 70% coverage level. In 2025, he's paying $13.68 an acre. In 2026, it should drop down to $12 if he had SCO and ECO. In 2025, you can see how those premiums change to 2026. When you lump them all together, if you had the whole package, his premium's going to go down almost $8 an acre. You go to the enterprise unit level, same thing. You're going to have across the board cuts from 25 to 26, but it's going to be about a third discount. You're going to be paying about 2/3 in 2026 versus what you were paying in 2025. Now that's if you take everything equal to what you took last year. The other thing it gives you is the ability to either buy up coverage levels if you wish, or buy additional coverages, such if you didn't have ECO or SCO in the past, and it's something that you looked at, but you were not wanting to pay that additional premium. With the decrease in premium on those products and the decrease in premium on your underlying products, a lot of times we can package stuff together for 2026 and get you more coverage than for the same amount of money you spent in 2025.
Good morning, everyone. We'll spend a little time talking about SCO and ECO. SCO stands for Supplemental Coverage Option. It provides coverage for your underlying MPCI. So say an example of 70 or 75% up to 86%. And then that's going to increase up to 90% in the year 2027. This is area-based coverage, so it's triggered on a county level. So as an example, in our county, Ransom corn, Ransom soybeans, Ransom wheat, all the producers and in the county would, its area coverage. Claims do start falling or paying on SCO when they gets below the county revenue of 86%, and it uses both a yield and revenue approach to that, and then those claims get paid on or before June 16th of the following crop year. So we've had several producers use this over the last several years, and so as an example for 2025 crop year, SCO and ECO payments, if it's applicable in the county, will pay here in the 2026 right after planting. ECO stands for Enhanced Coverage Option. It provides this same area coverage, just a little bit different approach. It goes from 86 up to 95%, picks off kind of where SCO leaves off. It's the triggered on the same county level basis. So Ransom corn, Ransom soybeans, Ransom wheat as an example. And then claims start paying when the county revenue falls below basically that 95 or 90%. Historically, ECO does pay before SCO because of the higher coverage levels, and we've used this product on our own farm, and I've had several insurance customers use it, both ECO and SCO. And historically, ECO generally is almost maxed out before the SCO pays because of the different levels of coverage. Supplemental coverage subsidies. So the nice thing about these products is, like Chris had mentioned, they've really increase the subsidy up to the current 80% from the past 65%. It will make it very attractive from a cost perspective to producers. So this spring, when you're talking to your insurance agent, you can go through and look at the different options, but it will be very cost effective probably in 2026. And for those producers that have been using it prior to 26, you will pay less. So it'll be a nice break in the premium there. And then the two main ones are going to be SCO and ECO. There's a margin coverage option too. It's got a little bit different timelines. We won't spend a lot of time talking about that. On the supplemental coverage option, there's a decoupled approach now so that you can buy SCO. And in the past, you had to have a PLC. PLC stands for price loss coverage at the FSA program. You can now couple SCO with your ARC price election. And so this spring, as you're making those coverage reviews with your agent, it would be a good idea to also make your election determinations at Farm Service Agency to see which product is a better fit for you, whether it be ARC or PLC, and then you can use SCO with either. Before you had to have PLC for SCO. And then the subsidy, the main noticeable difference is going to be the subsidy increase and the price, the premium going down. On the next slide here, this is just showing as an example for 2025. So won't spend a ton of time on this slide, but for soybeans, 35 bushel APH, both for 75% optional units or 75% enterprise units. The total premium for all these products in 2025 is kind of listed below the green, the blue and the orange. The green stands for the MPCI premium. The blue stands for the SCO premium, and the orange is the ECO. And it's kind of like layers on a cake. So I tend to go with the approach that the ECO and the SCO is kind of the frosting layers, and then the cake is your MPCI. But as an example, $29 an acre for optional and $17 an acre for enterprise in 2025. And then on the next slide, in 2026, we can notice a nice decrease. So for that same optional unit, comes down about $5 an acre to $25.14, and then on the enterprise unit, even a bigger decrease to $12.84. In a price environment like we're in right now, with some challenging break-evens relative to commodity prices, and the crop insurance, of course, uses the spring price approach here in the coming weeks into February. I think it's going to really allow producers to look at the overall risk management program that they have, either buy up their MPCI coverage to get to the levels that they feel are necessary, or add these additional coverages, the ECO and the SCO, to get to a good risk management approach for the 2026 year. And now is a good time to start. I would say probably by the end of January, first part of February, we're going to have a pretty good indication of the early snapshot and the price, what they call the discovery period, and working with your agent, and you can start to get an idea as we go in before the March 15th deadline. Next example is a slide on using our county ransom for corn for revenue protection. In ransom county, as an example, the T yield's 180 for this coming year, so you can get a 75% level enterprise policy, $621 an acre for about $13.61 of premium. And then for those individuals that want the SCO or the ECO coverage, I used ECO as an example here. You can get 95% coverage for $741. As an example, we've had a lot of producers over the last few years from a marketing approach with it's using a hypothetical price right now of about $4.60. This isn't entirely accurate going into price discovery, but you can see how cost effective for right about $20 an acre you could get coverage, so that if the area yield is anything below 95% of 184 in our county, which would kick in at right about $175 bushels an acre. It could provide that top level coverage, and then as an example, the MPCI would trigger at 135 bushel an acre. Just gives you some flexibility since it is area coverage. The MPCI is yours, and for the people that have used ECO, they've seen this, and the people that are new to ECO and SCO, it is area coverage, so it's not going to be your yields, it's going to be the county yield. Next slide is just a kind of a little deeper dive into kind of more that example showing the MPCI is still going to do all the heavy lifting in the green, and then the ECO comes in on the top to provide that kind of top level coverage for producers. As an example, are looking, at maybe say $700 to $800 an acre break evens for a cost acre of corn. You can get there if the $621 an acre coverage wasn't sufficient. You can get there, and it just kind of shows a good example there. In this next slide, you can, the rain and hail as an example has got a really nice tool you can work with your agent. You can basically see kind of how these kick in. So it shows that the expected revenue in our county would be $828 for MPCI at the full, basically no yield losses. The county guarantee is going to be $849.16. That's the expected county yield of 184. And then the MPCI guarantee gets us to 621. So there's a little bit of a gap there. ECO fills the gap. SCO would fill the gap as well. On this next slide, using Rain and Hail's software, this is a historical summary in our county of just how often that both SCO and ECO have paid in the last 10 years. So the one nice thing is that going into the better pricing of these products in 2026, they historically have paid. So most recently in the shaded purple areas, you can see the payments. In our area, it was 2023 and 2021. 2025 is yet to be determined, probably by my guesstimate. We had pretty good yields in the county, so we probably won't have a payment in 25. But you can see there's in the middle part of the page, the enhanced coverage option over the last 10 years, the loss ratio is 228%. So for those people that either have been using it or is looking at it, it does work. The supplemental coverage option has a loss ratio of 111%. So what that means, for every dollar paid, you got $1.11 back if you had it over the last 10 years. ECO, for every dollar paid, you would have got $2.28 back. So there is some utility that these products do provide. They do work quite well, I think, as a marketing strategy, as a hedge against some market volatility, as well as a hedge against weather volatility, especially widespread area losses, drought, heavy rain, early frosts, things that probably affect a broader area. In our area, 2021 was dry, a little bit drier, and then 2023 was a price loss here. So you can kind of see those examples there. Then moving on to prevent plant. So one of the downsides about between RMA changes here for the 2026 year is that they did remove the 5% buy-up. We're in the prairie pothole region in our area, so the 5% buy-up probably was quite popular. That's going to go away, so it's going to be just the base level of coverage for that crop without any buy-up. Back in 2018, I believe we lost, there was a 10% buy-up, so this was the only buy-up left. There was a premium charge for that, so for those producers that are concerned about that loss, the premium will be reduced, so there'll be a little bit of relief there. It probably is more important now that when you're meeting with your agent, that you do look at your prevent plant eligibility by crop, your max acres, to look at to see if we do get into a wet spring and have that prevent planting issues, that you're able to maximize your eligibility on per acres. In our area, as an example, corn, soybeans, wheat have different levels of prevent plant payments per acre. So working with your agent can have a good approach if you find that Mother Nature throws that curveball at us this spring. They did, however, remove the requirement from the 1 in 4 rule. So the 1 in 4 rule applied. You had to have the acres harvested and insured in one of the last 4 years. With that rule being changed, that will help some producers. The acres still need to be basically eligible, available for planting. And so working with your agent and AIP, it provides a little bit more flexibility, I would say, back to the producer level, especially on some of the areas that are problematic in the prairie pothole region.
Well, another product that became available this year in our area is CLIP, and that stands for Crop and Livestock Income Protection. And in North Dakota, the livestock doesn't apply, so it's really crop income protection, or CIP. What it does is it allows a producer to buy up coverage level to up to 85%, and it's going to be based off their own farm. So what it does, it puts your crops that you put into this CLIP policy, it kind of gives you like an umbrella or enterprise unit for your farm, your whole farm, for those crops that you elect to put into the CLIP. And the reason that was done is that, you've heard about, like in the Corn Belt, where a lot of producers are carrying that 85% coverage level because it's affordable. But if we go to the next slide, it'll show us the areas where this CLIP policy is available. And you can see it doesn't include the Corn Belt. A lot of those producers are at that 85% level on their underlying RP policies for their corn, soybeans, whatever crops they're growing, because it's affordable for them. But if you look at what it would take to purchase that 80 or 85% level in our area, it's really not economically feasible. So that's why most people are in that 75 to 80% on enterprise units, or 70 to 75% on optional units. So what this product does is that it allows you to ensure that gap between what your underlying coverage is. So if you're in the example that's on the screen here, the producer's got 75% coverage level on his corn and wheat and 70% on soybeans, there's a gap between that 75 to 85 or 70 to 85. So you get to ensure that additional revenue, and you can pick and choose what you want to do. So that in this producer, he's got 3 crops. He can choose to put all 3 crops into that CLIP unit, which is just one big unit that's based off of revenue. Or you can pick 2 crops to put in there, and he can pick whatever combination he wants to do that. So that's something that is going to take some time to look at and see if you want to buy some additional coverage, some additional revenue coverage. It's a feasible product to look at. The advantage to it is it's based off of your own farm. So, when Lance was going through the ECO and SCO policies, he mentioned that it's based off the counties and area plan. So the county has an established yield, and that's what the expected county yield is going to be. Well, there are some counties where you look at that expected county yield and it's not very enticing. If that expected county yield is at or below the county T yield, I'm not too excited about some of those area plans. And with this CLIP plan, you're using your own yields, and you're using your own APHs to set your liability or coverage, and you're using your own harvested yields to determine if you're going to have a loss or not. It's not based off of the county. So that's the advantage to it. The other advantage is if you do have a loss, you get paid once your loss is adjusted on your underlying policies. You don't have to wait until the spring or June until the final county yields are established. It is subsidized. The subsidy level is at 80% here. That's what it shows on the chart. So the next slide, I think, has a kind of an example of a quote. Amanda, could we move to the next? This is just a CLIP illustration with 2 crops on it. This is Benson County. We got soybeans and corn on it. So In this example, if somebody had 1,000 acres of corn and 1,000 acres of soybeans, he would be adding just under $100,000 of additional coverage to his operation, and the premium would be about $19,500. So what we're seeing on this typically, as you look at it, is we're looking at about anywhere from that $5.50 to $6.50 of coverage for every dollar of premium. So it's like I said, it's an additional way to buy some higher level coverage. It's cheaper than going to 80 or 85% on the underlying policy. And it's going to be based off of your own records or your own yield history to determine your coverage level. And it's going to be based off of your own farm's yields to determine if there's a loss or not. So this is something, if you're looking for additional coverage, it's an option to look at. There are a lot of options out there now. If we look at what we have available to us now versus what was there 10 years ago, there's more to look at. There's more to dissect. And sometimes it can get more complicated, but that's why it's important to sit down with your agent and kind of go through a plan, what you're going to plant, where you're going to plant it, and look at your available options. It gets more complicated, but it's nice to have these options because it gives us an opportunities that you didn't have 10 years ago to add some of this additional coverage. On the CLIP, this is same thing, same deadline as our underlying policies will have. For us, that's a March 15th deadline on it. Again, claims aren't going to be paid on the CLIP until the underlying policies. If you had let's say you had a loss on soybeans, that soybean loss would have to be adjusted and paid prior to the CLIP claim being adjusted. Some other changes that are happening for 2026. Every year, RMA looks at certain crops and adjusts the T yields. The T yield, what that actually is actually 10-year history for the county. So it takes actual yield data from crop insurance policies, and it's a 10-year average. So these crops are on about a 3-year rotation schedule. So every 3 years, they'll look at these T yields and adjust them. And for 2026, an example for Benson County, you can see that our APHs have increased, our county T yields have increased. And for an example, when I first started back in 2011, that county T yield for corn was sitting at 78, and now it's drastically higher. Across the board, if you compare 25 to 26, we're going to see increases on these corn T yields, and that's just a reflection of what we've been seeing coming off the farm. The other crop that had some T yield changes is barley. Again, barley's not the crop is kind of, the acres have disappeared quite a bit here in the last 10 years. It isn't growing with as much prevalence as it once was, but we're also seeing some increases there, not as drastic as corn. And where these T yields are important, if you don't have yield history, let's say you're farming in a county you haven't farmed before, or if you've never raised a crop, what you're going to use is that county T yield, or you're going to, until you establish 4 years of your own history. So you'll be using the county T yield or a combination of your own history. So sometimes on these crop rotations, it takes a number of years to get that 4 years of history in there. And then it also is used on the yield adjustment option or YA option. So when these T yields change, a lot of people it won't affect them, but there are some people it does have an effect on them. The other thing that's changed, this isn't something that's going to be where Lance and I are at, but if you're up in Northwest North Dakota, camelina is now an insurable crop, and there's 11 counties. They're all highlighted in that map. And then canola, one thing to keep in mind, in my area, I'm seeing more and more canola acres show up in the last couple of years. As of now, that the talk is that it's going to increase for 2026. We'll see what happens, between now and spring. If you're raising high oleic and you have a contract with a end user on that, we can use the contract price option, insure it for what your contract price is versus what the spring price is for RMA. So that's an option. We have to have that CP option on the policy, and that contract has to be executed or available by the acreage reporting date for us to do that. One thing that, again, just to review, production, it's important to get your 2025 yields in if you haven't done so. The reason for it is it gives your agent the ability to look at up-to-date and current information when looking at your 2026 options. Some of the options that we can use on the policy, trend adjust, personal to you, floor option, those all vary, and it really depends on having the correct information to determine, what your coverage is. So the goal is always to get you the best coverage for the most economic price. And then claims, we just want to make everybody aware that there are deadlines. They're not deadlines that are set by us. They're not deadlines that are set by the AIP, but they're set by RMA. And we have to get the claims entered timely, otherwise it can be denied. For an example, if a producer's hauling weed out of their bin now and they find out they've got low falling numbers, it's too late to enter a quality claim if one hasn't already been entered. We need to have claims entered within 15 days of the end of the insurance period. That's considered timely. 60 days is the max. End of the insurance period is the last day of the harvest or the calendar date of the end of the insurance period for the policy, whichever comes first. On these revenue loss claims, we need to get those submitted within 45 days of the price announcement. And just make everybody aware that for dry bean, lentils, and dry pea producers, those revenue prices were just released this week. There are some large decreases in between the spring price and the fall price for dry beans. You're looking at anywhere from 22 to 24% decrease from spring to fall. So producers could have produced at or almost close to their APH and not had a production loss, but they might have a revenue loss. So if you're a dry bean producer and you're in that situation, you may think that you didn't have a loss, but make sure you get your production into your agent and go over that. And so he can have those numbers and look at them, crunch them, and determine if a claim needs to be filed on the revenue side. And then to keep good records, keep your slips marked, keep load records, keep bin logs, whatever you need to do to be able to prove where your production came from. So once you get into a loss situation, you have accurate information for the adjuster. And the other thing is if you have a crop that you're going to destroy because it has some issues or it's going to be put to another use, always make sure you make your agent aware of it and that either a request for an appraisal or a claim is sent in before you do that. Common situation that we see is like oats is insured for grain, cut for hay, barley, silage that's insured for grain, or corn that's insured for grain but cut for silage. Those need to have appraisals done on them before they're either hayed or cut for silage. Lance, you want to take that?
Yep, I'll so a couple things that we just kind of like to touch on to all the producers and growers out there. So there's a couple FSA programs that are currently being administered. So this last summer, there was the SDRP Phase 1 program. That was an automatic increase for any 23 and 24 crop insurance losses. There is currently the SDRP Phase 2 program. So for those producers, you might want to inquire with your local FSA office to see if you qualify. The SDRP Phase 2 is a shallow loss program that's geared towards non-insurance losses that Phase 1 picked up, but there's some applicability for those producers in 23 and 24. There's also just lots of talk. You'll probably read in different articles, see online, and then as well as talking to your friends and neighbors this coming year about ECO clip as well as livestock protection LRP. So there's a lot of opportunity out there to manage risk in 2026. With the products that we've had a chance to talk about here, I do think it puts producers in a fairly good situation. We are in a tighter commodity price environment. And then with the livestock side, there's some opportunity there. With the bigger subsidies and product flexibilities, I think the overall goal nationwide as well as locally, is to have producers be able to either buy up coverage or buy more coverage at less rates. For those people that were already buying that kind of coverage, there should be a premium reduction. But maybe for those operations that want to approach the risk game a little bit different, you could either buy up or buy additional products in 26 without adding any extra expense there. And then RMA rates and data kind of continually come out throughout the course of each year. Chris talked a little bit. We're seeing some data for yields and everything, and then the price discovery period. We're going to start that here for the spring crops, starting the 1st of February, and goes through the month of February. And if you're talking to your agent, you'll have a pretty good idea about what all those prices are, and then those prices will be announced at the end of February or first part of March, after we get through price discovery for the revenue products that are available. A couple things to keep in mind for 2026. It is still a very challenging commodity prices environment. There is right now, with increased expenses and inflation, and I was just talking to a lot of the producers we work with, it's going to set up the stage a little bit similar to 2025, but set up the stage in 2026 to really analyze, look, probably revisit, just to make sure a person's risk management game matches to create the best, either hopefully break even and or profit scenarios for 2026, and as well as a person's marketing strategy for any potential marketings that producer wants to do. The sales closing date is March 15th for all products, and then there's also going to be some additional buy up once we get into the growing season for hail and all the private products and stuff out there. There is some also additional products. We're past what's called pasture rangeland and forage deadline. That was December 1st. But for those people that have been using it, or it's been a really valuable product, especially when we get into drier periods across the state. And then for those producers that aren't using it, especially if you're in a livestock or forage operation, very valuable. Annual forage, very similar, provides a nice level of coverage for those forage producers. LRP, livestock risk protection. The cattle markets right now are kind of a real shining spot in the agricultural world. And there's some tremendous opportunity to lock in some future market opportunities with the current hot cattle markets that we're seeing. And then as well as there's also forage production. And talking to your agent, those all have different timelines. LRP's out every day, and then PRF, annual forage, and forage production have different deadlines throughout the year. Just as an example on the LRP side of things, this is just a slide kind of showing feeder cattle. For those people that haven't calved yet, just to recap, you can lock in up to 52 weeks out your unborn cattle. Just an example, they're over $2,000 a head, for unborn steers and heifers. So some fairly exciting market opportunities there. And then on as well as on fat cattle, or pretty much any classification feeder cattle. So say if for those people that would be either purchasing cattle or raising, feeding finished cattle at all stages all the way out through finish, there's some pretty exciting opportunities there to lock in profit. That's the one market that really we're getting a lot of questions and excitement because of the excitement around the cattle prices right now. And then with that, I'll probably turn it back over to Amanda for any Q&A, but thank you, everybody.
All right. Lance and Chris, one question. As you guys were talking about CLIP, is there certain crops that are not covered under CLIP, or what is the crops that are? I know you talked about livestock is not in North Dakota, but is there certain crops that may be grown that aren't covered?
I'll find my list here, but it's pretty inclusive to pretty much all the crops that we raise here. I got to find a list to give you a really good answer on that. That might take me a second. Is there another question you want to move on to while I look for that?
Just okay, so maybe this is I think Lance, maybe you talked about this, or Chris. So going back to that beginning farmer program, how it's now increased from 5 years to 10 years. Let's say you have a scenario of a young producer who is been farming for 7 years, but this is actually the first year he's going to actually be purchasing his crop insurance. So how would that work for his eligibility and subsidiary price rates?
So the beginning farm rancher app policy and the application, you're eligible for that benefit for up to 10 years. And if you were active farming or ranching for any time period, whether or not you had a policy or a crop insurance policy or not, that'll take away from that 10 years of eligibility. And there are some years that can be excluded. So if you're under 18, you can exclude any years that you'd been farming or ranching. If you're in post-secondary education, you can exclude any of those. So if a producer was actively farming and ranching and they started when they're 16, they're in high school for a couple years, they're in college for four years, there's 6 years that they could have been actively farming or ranching. It's not going to take away from the eligibility. But there are requirements to prove that on that application. That's all part of that application process. So that's something you need to sit down with your agent and go through it. And actively farming and ranching is going to be defined by they'll ask, are you enrolled in any FSA programs? That's one thing. So if you're doing that, you're actively farming and ranching. The other thing I ask is, did you file a Schedule F? Have you declared any farm or ranch income? Well, that's the active farming or ranching year too.
Thank you. Here's a CLIP question. So as we were going back to those crops that you need to have on there, if you add additional crops, let's say from 2 crops to 3 crops that count, does that premium price change?
This is new and I haven't done enough with it to give you an honest answer on that. We haven't hardly worked with it or quoted it. We're kind of early into the 2026 year as far as looking at quoting different policies and crops. One reason is the prices aren't even established yet. So it kind of there's a lot to learn on this yet, and I've got a lot to learn on it. So I don't know what the scenario is on that. If you expand your unit, make it larger, you go from 2 crops to 3 crops, expand your coverage level, what effect that has on the premium. So that's something I have to play with the numbers on it to give you an accurate answer.
Okay. And whoever asked that question, we will be sharing Chris and Lance's information. So if you want to maybe contact them or me, I can get you in touch with them, and I'm sure they'll be able to find an answer for you in a few days and follow up with that if you would like. Maybe this is just out of curiosity, Lance, Chris, now that ARC and PLC enrollment has been pushed back do you think that's going to have any impact or affect any way that producers do their crop insurance selection and stuff? Probably not as much, that ARC doesn't need that you can buy SEO with ARC now. Do you see any?
Take that. Yeah, I can take that one. So for the 2025 year, with the changes in the One Big Beautiful Bill, any applicable ARC or PLC payments, the producers will get the higher of. So for 26, they'll do an election. And then there's also some, I think, updates one-time updates they can do at FSA to bases, I believe. But they'll probably want to reanalyze that. NDSU usually has a nice tool out there on their website to analyze ARC and PLC for the 2026 years. There is updates to reference prices that were made as part of the One Big Beautiful Bill as well that will be beneficial. So that's why people get the automatic of the higher of in 25 with the reference price update, and then they can make the elections in 26. So it'll kind of be on a farm by farm basis. I think based on those producers' base acres, but there were some beneficial updates. Perception, ARC was a lot more popular down here the last probably few years, just due to the formula. However, PLC did have some applicability for certain areas and stuff too. So I think it'll be on a producer by producer basis, but they'll want to review that either with their crop insurance agent or at a minimum with FSA, and NDSU had a nice tool out on their website for analyzing that.
Thanks, Lance.
I've got the crop list here for you if you want to go through that. So here's one thing I should have mentioned on too, on that clip. You have to have RP coverage or revenue protection coverage for a crop to qualify. So let's say you had barley with white pea with a contract price option, you could not put that in the clip. And because that's so, majority of our crops are going to qualify, but like potatoes and sugar beets aren't going to be eligible for the clip. But if you look at barley, canola, corn, dry beans, dried peas, flax, oats, soybeans, sunflowers, we can put all that into the clip if you wish to.
Thank you for looking that up, Chris. Another question that came in. I have a young producer that is joining our farm and has a percentage instead of his own acres. We are a JV. Does his percentage qualify for beginning farmer?
Does he have a separate insurance policy, or are they insured under one policy?
That I do not know. That again, whoever asked that, Chris. Oh, one. I think they're just one policy.
Okay.
One policy.
I think they'd have to probably look at that and see if it'd be beneficial to split the policy.
Thank you. You can always reach out to your local agent, or Chris and Lance again will be sharing their contact information and this presentation. Later today, I will be sharing with you guys, or tomorrow. One question that did come in about Prevent Plant. So Prevent Plant coverage still exists, but only the 5% buy-up was eliminated, correct?
Correct.
Might the enhanced coverage level help alleviate this change? Oh, sorry, Lance, you're on mute.
Yeah, great question. So the enhanced coverage option does not have any Prevent Plant applicability. So Prevent Plant is paid on a policy level basis. So as an example, if a producer had 75% coverage or 70% coverage or 80% coverage or so, and that it's going to be pretty critical this year with the 5% buy-up change, that the individuals re-evaluate their Prevent Plant strategy as relative to their coverage level. So as an example, if a person historically had 75% corn on an enterprise basis and was concerned with the buy-up going away, they would maybe want to look at 80%. Going up in coverage would increase their base Prevent Plant since we won't have the buy-up. So producers will probably want to reanalyze that. And then there's two functions with Prevent Plant: yield and price, and then whichever crop, and corn and soybeans and dry beans and sunflowers and so on.
If I could just kind of clarify something on that. BFR. One thing to keep in mind is that when you have a policy that all the SVIs, everybody that's listed on that policy has to qualify for the BFR to get that advantage on the policy. So what that means, if you have a husband and wife, if the husband has 1 year history and the wife has 11, they don't qualify for the BFR. Policy won't qualify. If you have a partnership, same thing. If one person in the partnership qualifies, but another person doesn't, that policy won't be eligible for the BFR benefits. So that's one thing to consider. There is ability to split a policy up. You can insure your share of a crop on one policy, and the other individual can insure on another policy. Those are just things that it's important to sit down and start thinking about now, because you don't want to start thinking about that on March 14th, because there's just not enough time really to go through all the scenarios and give it the deep thought that it needs. So if you're in that type of situation where you possibly could take advantage of something like that, start talking to your agent as soon as possible.
Thanks, Chris. Lance, there's another question that kind of came in around that PP. So if the PP 1 in 4 rule is eliminated, how does that work after a few years? Let's say it would be allowed back in, or does it have to be seeded and harvested before it can be brought back in between that 1 in 4 rule elimination?
Yeah, great question again. So up to this point, it had to be harvested and insured in one of the last 4 years. To my knowledge, with the change now, it needs to be available or eligible. So there's probably going to be a little bit of clarity in the next couple of weeks, months, as we go through the spring season with each AIP. But it's intended to provide more flexibility. I still think that ground, in my personal opinion, probably needs to be available. It historically needs to be farmed. So to use sloughs as an example, or areas that are deeper in water, that won't necessarily make them eligible, but maybe some of the more shallow wetlands that were farmable in certain years, but maybe struggle with the 1 in 4 rule, it might pull some of those in. So you want to be talking to your agent and your AIP. There's going to be some clarity probably in the next probably weeks and months surrounding that, but they removed the 1 in 4 requirement, but it still is going to require that the ground be available.
One thing that you got to keep in mind that the requirement was that it has to be planted 1 out of every 4 years. They removed the insured requirement. So some of the times when we ran into problems up here is like if the land was PP'd for a couple years and then somebody put a hay crop on it, they planted it, harvested it, it wasn't insured. So oats, millet, something like that. And then it went back into PP situation. It wasn't eligible for prevent plant coverage because it hadn't been planted, insured, and harvested in one of the last 4 years. Now that's not going to come to that situation anymore. If it had been planted and harvested in one of those, or destroyed by a natural cause, it's going to be eligible for PP. And I don't see it as being a big issue, but it will affect, I think, primarily like the livestock producers where they had land where they put into hay production, haven't had it insured, and they've really ran out of PP eligibility because it wasn't insured in one of those last 4 years. That's what I see in my area is where the biggest effect is going to be is with my livestock producers. My grain producers that are just grain producers, I don't see a big change.
Good point. Yeah.
Well, thank you, Lance and Chris. We are coming up to the hour of 11 o'clock. Again, if you guys have any questions, feel free to reach out to Chris Lance. I will be sharing their information. Also, if you want to rewatch this presentation or share it with anybody, you can find it by going on to YouTube and searching NDFU. And with that, please be on the lookout for our next webinar on February 19th. Again, thank you all for joining us and have a great day. Bye.
Thank you.
Thank you.